Good afternoon and welcome everybody for joining. Thank you for joining us today on this webinar on an update on what's going on with the markets and where we're at, and we hope to give you some insight. If you're joining us by phone, welcome. There's not a lot of graphics that we'll use today, so you'll be able to very much listen in. As well as if you're joining us live on Facebook, thanks for joining us. And if you feel like this is good information, I invite you to hit that share button and share us with your Facebook friends. So we got a lot of information to cover. There's been a lot that's happened just over the last few days. And I have with me today, as you can see on the screen, if you're watching, Beth, Foley, Matt Aurenz, and Bill Davis. And they will give us great insight as well as how we're thinking about this as we move forward. The way that we're thinking about our delivering this message is every week, 3 o'clock, and of course it is recorded. If you don't get a chance to watch it live, you can watch the recording. And as I said earlier, there's just been rapid amounts of change. And so let me pull up here what our agenda is, and then we'll start down our bullet points. So the first thing is we want to talk about the CARES Act, which just a few minutes ago was signed by the House, and now it's moving on to the desk of the President. And he will sign it, and this is the $2 trillion bill that you've probably heard about it. It's been in the news, obviously, called the Relief Act. And we're really calling this, well, it's called the stimulus package. We're really calling it the relief package. And we'll talk more about that, and we want to talk about the Fed actions. We want to talk about, we don't think it's over as it relates to the markets. None of us obviously are healthcare professionals, so we're not going to guess from a healthcare perspective, but we're going to talk to you about the markets and where we're at, and then we're going to talk about where we think, what's next. So let's talk about the CARES Act. So to my colleagues around the screen, and we are practicing social distancing, by the way. We're all in homes or our offices. We're fully functional as a firm, so most of the team members are out working in their homes, and we've been fully functional for some time now. So who would like to start with some just oversight as we think about the CARES Act in general that just got signed by the House?
Yeah, I could start, Eric. I mean, we're pretty excited about the $350 billion in small business loans. That's a big chunk, and the $250 billion in unemployment, raising the unemployment. The states can raise the unemployment up to $600 a week, which will certainly help so many people that are displaced due to no reason of it wasn't their issue. It was the coronavirus that caused it. State and local governments will have access up to $150 billion. They've slotted $25 billion to the travel industry, and all the way even down to travel agents can apply for assistance because they've been decimated due to the travel industry shutting down. And certainly the stimulus money that will come to individual taxpayers is going to affect even some people on the call today, I'm sure.
We were participating in a web conference yesterday that was hosted by the BlackRock company, and there was a phrase in there that it just struck a chord with me, and we've talked about between the four of us over the past couple of days, is that the CARES Act, or the relief that is being given, is really meant to be a bridge. I think bridging us from pre-coronavirus to eventually post onslaught of the coronavirus, when hopefully we get to that point that we hear about in the news, of leveling the curve and a point where all be quarantined at home, but getting back to hopefully business as usual. So the CARES Act is a bridge to kind of help people pass through or pass over this incredibly difficult time right now. And to Bill's point, as far as the dollars that are being made available to small companies, large companies, and individuals as well. So thinking of it as a bridge to get us through and to what may very well be a new normal for us. Hopefully not in the too far distant future.
Yeah, and what we think about, is we have heard back in 08, 09, when they worked on a stimulus package, it took them several weeks to kind of get through that and get that into the system. And I think that was around 800 billion, whereas it just took several days here. So it may have felt, because of the news media and kind of the extent of it, it was a, kind of a drawn out process, but it was needed. It had to get to the system quickly. And we felt like, it got through on a pretty short term, pretty quick. So, Matt, what about the Fed actions? And I think that's probably really a lot of times misunderstood as to the actions they had to take, and how we're thinking about what the Fed has done so far.
Yeah, I think the Fed is really just trying to figure out a way to keep some stability, and at this point it's pumping money into the monetary system to curb bank runs, concerns about breaking the buck. A lot of that discussion really hasn't even begun yet, like it did in 08, 09, which is good. I think their goal is to really just infiltrate the bond market and the stock market with just some cash flow. Particularly in the bond market, it's interesting, even as they begin to buy, corporate bonds in the ETF format, with potential concerns that some people had of, are those going to be liquid or not? But I also just think at this point it's becoming such an avenue that I think in the long term people will be primarily in that space, especially when you can just buy it based on an index. So it doesn't necessarily have to be a straight treasury bond. They can help out individual investors who are owning ETF positions and looking for liquidity, where people aren't owning really just individual government bonds anymore. So it's an interesting step. I think it makes sense. Again, we'll see what happens generations to come, but for right now, it's the influx of cash that the market was asking for.
Yeah, I would add to that, Eric, that, the Federal Reserve Bank is the lender of last resort, they call it. And so many of the large corporations are drawing down their credit lines in preparation of making payrolls and, trying to treat their employees well. So, with all the banking regulations that went into effect in 2009, now to have the Federal Reserve be able to infuse capital into the banking system to support these drawdowns of big credit lines that companies are doing in preparation of how they're going to be able to sustain their businesses and come out of this, so that we have a short-term recession, not a long-term recession.
To Matt's point as well, I think we all four of us remember, and several of you do as well, of when things did seize up in 2008 and the country's largest money market account was frozen and people could not get dollars out. And by making this money available and pushing it into the markets, it's really just all about liquidity and helping to calm some of the stress as well, of knowing that if you need money, you're going to be able to get your money. And I think that's incredibly important to help people manage through this period of time and just remain a little bit calm, knowing that if they need to get their dollars, they can.
Yeah.
The other thing I would add that was actually interesting, I probably appreciated a little bit, was just the ability for them to go into the municipal bond world too, where they didn't just keep it on the government and credit side. They actually helping out municipalities by purchasing some of their fixed income. And that's really just kind of a safe haven place that a lot of people go to. And the municipal bond world, because of the influx for people looking for looking to go liquid and credit spreading so fast, it really rattled that market. So just them helping out the municipal bond world, I think also just brought a little bit of calm that was needed.
Yeah, and don't we think, I mean, we've talked about this, and I think everyone on the call and joining us in multiple medias is that there was a lot learned back there in 08, 09. Unfortunately, they went through it, and there's a lot of folks that participate in the Fed, in the Fed that lived through that piece. And so I think it could have been a lot worse this last couple of weeks. If they wouldn't have had those learning pieces.
I would agree. I mean, Jay Powell's new, but the team around him, a lot of them are the same people that have gone through that 08, 09. And so, again, I don't think they did everything right then, and I don't think they're doing everything right now, but they're doing something, which is at least good. And so they are gleaning on past experiences, which do seem to help support current market stability.
Yeah. One of the things that all of us advisors have watched, there's a piece I'm going to encourage you. We'll put a link on our resource center on our website, which I'm going to just share with those that are online. But there was a piece from 60 Minutes last Sunday that the president, I believe, of the Minneapolis area Fed did an interview, and it was a very good interview. He has a lot of experience. He was around in 08, 09. And so I would encourage you can Google it, and we will also put a link on our website that just kind of references the Fed. And then the other thing about the Fed is that, they have a lot more levers to pull. So they're not out of choices and things that they could do if they need to do it. So, so it needed to be done. So the CARES Act, Bill mentioned some of the things in the CARES Act, and there's obviously a lot more detail in there. 800, I think, and 30 some pages is what it is. And so everybody on this webinar and call and so forth, besides potentially getting a check, there's a lot more planning details that we'll go into next week. So you got to make sure you join us next week. But maybe someone can just share a couple of the highlights that we think will affect a lot of the folks we work with and folks in general.
Yeah, I'd like to start because the one that we learned about this morning, I've already made some phone calls to clients today calling out on it, is that, and I think this is great, is that required minimum distributions for those of you who are over 70 and a half and have been taking required minimum distributions are going to be suspended for the remainder of 2020. And that's important because if you think about it and where the markets were on December 30th of 2019, when the required minimum distribution amounts for 2020 were calculated, the markets were very high. And I remember having conversations in early January with people saying to me, oh my gosh, my RMD is more this year than it was last year. And that has not just to do with age, but where the markets were. And now the markets have fallen, 35% off their peak. And so more shares would need to be redeemed in order to meet the required minimum distribution. So we've got this big number and we don't have as much value to support that. So required minimum distributions having been suspended for 2020 is a really good thing to see in there. And so it's not just about checks in the mail. There are all these really interesting little pieces in there, such as student loan payments, subsidized student loan payments suspended, I believe, until September of 2020. So I'm looking forward to us spending some more time with it over the week so that we can disseminate it on this call next week.
Yeah.
Yeah, Beth, I think they're also going to allow people that have already taken their required minimum distribution to return it to their IRA.
Yep, correct.
The other thing that stood out to me was if people do find themselves in a difficult situation, they're going to suspend the 10% early withdrawal from an IRA for people that might need to tap into their 401k or an individual retirement account to maybe make cash flow if they're laid off or whatever. And that could come into our planning as well in the upcoming months.
Yeah, it's a great point. The other thing we talked about as a team, and we want to make sure everybody is aware of this. Maybe this isn't quite for you, but maybe you have somebody, maybe a child or a relative or someone that you know. Many of the financial institutions are allowing a delay of payment, whether that's your mortgage, your auto loan, things like that. They're trying to work with their customers. And so if someone finds themselves that they need to delay those things, we encourage people to reach out to the institution where that loan is originated and see if they have any of those provisions. There's some things with charitable deductions and so forth that come into play. So we do think there is, if we think about, and how we think about it is, we're on this journey now to get to kind of the other side. Mentioned that earlier. Along the journey, if we can do some things to make it a little bit easier and utilize some strategies, once you get there, you'll be better off. So a lot of things that are underlying that, probably a lot of it you won't hear in kind of the national press and so forth, and digging down, and that's where we'll be working with all of our clients and trying to determine what's best. Good. Well, let's move on to it's not over. So, we've had some market ups. We've had some market downs. Obviously, we've had some market ups this week. So, Matt, maybe I'll let you start with director of our asset allocation and wealth management, and just kind of make a comment, and let's have a discussion about that.
Sure. Where to begin? I think right now, in good news, what we've seen is a 3-day recovery. Obviously, it looks like the market will finish down today. And that's okay. I mean, we're going to have increased volatility for a while. The 4, 5, 6% swings in the market are going to probably feel commonplace for a little bit. That doesn't necessarily mean that's a bad thing. It's just kind of where it's at. And so, we didn't break through some technicals. I think we're starting to see a slight trading range. Bill was talking earlier, we'd like to see a little bit more of a trading window, and I think he'll talk to that in a little bit. But it's interesting, even yesterday, I thought for sure the market was going to be down with a jobs report unemployment report that was twice as projected, and the market was up. And so I think there is hope that people have on this relief package that we'll start to see take place. Are we done? Are we done on the downside? I'd love to say yes. As we look back at previous history and various theories, there's a couple out there that would potentially suggest one more down. That doesn't necessarily mean it's going to go down past the trading ranges or resistance levels that we've already experienced, but potentially another down. And then we would be on the upswing. But I do think that things like relief packages, government assistance, and intervention really, create anomalies in those types of theories. And so this potentially could be one of those. Again, I think it's just hold on for a little bit. If you've already experienced the declines this far and you're holding on, I think that makes complete sense, and I applaud you for doing that. I think, again, mathematically, it works the best in your favor. And I do think that now becomes this opportunity of, okay, once we start seeing this trading range, rebalance the portfolio, stick to the core holdings. There's a reason that you have that allocation, because statistically it works long term. And so begin to take advantage of selling some high and buying some low, and owning more shares of something. And who knows, in 6 months, you'll probably be selling off profits again in a different asset class. So those are some of my initial thoughts.
Yeah, when you think about the market, I mean, it really, as far as trying to guess it, the weekly unemployment claims were what, Matt, about 200,000, 210,000 average, right? Prior, and then yesterday was 3.2 million. I mean, not even, wasn't double, was just and we're going to have more to come. So that's why we're saying it's not over. And if you hear anybody, first off, we encourage you to minimalize following and listening to this press and so forth. But anybody that's trying to guess when it's going to turn around is is just that. They don't know because there's the unknown, obviously, and the COVID-19, not sure where that's at and when we're going to start to see that curve, kind of plateau and then come down.
We as a group, started talking about this old adage that we've lived with before, probably going back to 2008 of, when you have proof that it's a good time to own a particular company or an index or a fund, you don't have the price, meaning that, when you can see that it's doing well, the price is high. But when you have the price, you don't have the proof, which is when you have a good buying opportunity, you may not have the proof. As we're sitting here today, there's all kinds of buying opportunities, but we don't have any proof or knowledge as to when we're going to emerge from this. And that's kind of a double-edged sword here, because on one hand, we've got the price, and if there's something that you have wanted to buy or feel that you want to own, we don't have the proof. So, you're taking a little bit of a leap of faith that we're going to move through this and how long it's going to take to move through it. But caution on the other side as well of, I was referring to it yesterday as the shiny penny syndrome. There's a lot of companies there that have really attractive prices, and I would caution away from, okay, that looks good, let's buy that. That looks good, let's buy this. We don't have the proof yet, and people shouldn't stray away from their investment time horizons, their risk tolerances, what they know and understand, and just go, willy-nilly as far as I want to buy this, I want to buy this, I want to buy this because the price is there. So, we have price, but we don't necessarily have proof quite yet. So I would just, know what your risk tolerance is, know what your time frame is, what are your cash reserve positions that you want to hang on to, and stick to your fundamentals as we move through this and bridge to the other side.
Yeah, I'm very, very optimistic about, what the future is going to bring for the market. But the whole concept of it's not over yet is, we've experienced things like 1987, 1999, 2008. And every time we tested the downside again after we started to see some recovery. And that's the whole point of the trading range conversation, is that we need to see some floors at whatever the floor is going to become. And we need to see some ceilings and whatever the ceiling is going to become before we're going to start having those breakout moments that are going to take us back to the levels that we were at before this whole thing started. So I think if we can exhibit patience, because until they get their arms around the coronavirus, I don't think we're going to have any confidence in the market that we're going to actually establish that positive trading range. And this could take a little while. So I don't like to be the bearer of bad news. I just don't see a V recovery happening in 4 weeks. It might be 3 months. So whenever we see that, then we'll be prepared to get back to our asset allocation and move our weightings of equities up.
Yeah, and there's even some good news that when you talk about just what is this doing for people, company wise. Delta just came out, the CEO said, hey, this influx of cash for us is going to allow us to employ people through September, at a very minimum. So those types of things, I think, are really going to help begin to stabilize certain companies, certain industries, what that stock price looks like. That doesn't necessarily mean, like to Beth's point, that you just jump on the shiny penny. I mean, you still have to kind of see how that plays out a bit, particularly since we're seeing an increase in cases where people, are testing positive. So until we see a little bit of how that shakes out, with how long people could be potentially out of the workforce and schools out of being in actual class, those types of things. There's just a lot of unknown variables at this point. And so as we gather this data as much as possible, we begin to see what that trading range looks like. But again, I'm with Bill. I'm really optimistic at this point of saying, as of yesterday, I mean, technically we're out of a bear market. The indexes rose up enough that we were out of it. So are we? I don't know.
Yeah.
Realistically, I'd like to be optimistic there, but we're just going to see some volatility. So I don't think that we're going to see massive declines. I think we're just going to be volatile. And so, your daily balances are going to swing. It's a day trader's love right now, if you want to play that game. But at some point somebody's going to get burned somewhere. So we just want to be on the right end and just say math works on our side. We don't want to be in the day trading game.
Yeah. Good. Well, hey, we've got several questions. We'll take a couple of them here. So status of muni bonds and where those are at. Matt, you kind of addressed it, I think, that, but you may just want to just high level talk about those and how we think about muni bonds.
I still like muni bonds. I mean, there's obviously some tax advantages there. I think when credit spreads kind of tighten back up a little bit, that's going to help them. You know, a lot of the muni bonds that people are invested in are revenue sourced muni bonds that do have some type of payment structure, that they do have a revenue coming in to pay those obligations. And again, you know, bonds have to mature at their par price, and so some of it is just a waiting game. So if you're in a managed mutual fund, something of that nature, those portfolio managers know what they're doing. They're just seeing what that short-term volatility looks like in there. But I don't think they're stressed out or freaking out at this point. Again, I think when you look at those being 10, 15, 20-year obligations, they're going to get back to their par prices. You just might have a little bit of a waiting time. It's not the time to sell those. I think we will see a pretty good rebound in the fixed income world. So hold on and just, you know, if anything, if you don't need the income, just reinvest the dividends to buy more and take advantage of that opportunity.
Yeah. Hey, for the panel, next question is obviously with the $2 trillion, we're taking on a lot of debt. And what happens to interest rates and inflation, you know, over, you know, longer term, and won't some adjustments needed to be paid for this in the long run? I'm sure everybody's thinking that, right? $2 trillion. Oh boy.
Yeah, fortunately, we have historically low interest rates. So it's, you know, they've run some numbers that, you know, we can handle this additional debt because of the low interest rate that we're going to pay. But remember that a lot of people are waiting in line to buy our government bonds, even though they're paying a negative return. So as long as what the government's having to pay back on that debt is at such a low interest rate, we can sustain this for quite a period of time.
Yeah, and the good news, you know, a lot of foreign countries at this point are either at zero or negative rates. And so to your point, Bill, they're looking for a place to actually park some assets so that they are generating some type of income. But long term, what does that do? You know, I think what'll be interesting is, which I haven't really wrapped my head around yet, is just, you know, even things like deferment of required distributions this year. That's a lot of tax revenue that the government gets. And so some of those things will be quite interesting to see what the long-term tax implications are, particularly since the Trump tax cuts, you know, a year or 2 years ago. So I don't know what that'll do in corporations. I don't know what that'll do for individuals, but we will probably have some fallout from this. There's no doubt about it. The difficulty right now is calculating what that's actually going to be. We just don't have enough data yet.
Yeah, and kind of the way they transfer, right, it gets pretty complex, but transferring the debt to the Fed balance sheet and how that works. And you know, there's some of those components that go into play as well. And the other side of it is we kind of feel like, this had to be done, right, the relief package. So there's not, you know, it comes into play, it just had to be done. I've had questions, and there's a question that's come in about, you know, the Fed making a statement that they're buying ETFs. And obviously we use a lot of ETFs in our portfolios. Again, we covered it a little bit, but any additional comments about that besides making sure that there's liquidity in the market?
I think just the ease of the ETFs and getting a broad diversification by using them, the Fed is getting some good advice. It was announced today that they're working with the BlackRock company to advise them on what to buy, when to buy, and so forth. And it's not too much different from 2008. BlackRock advised the Fed at that point in time as well. But just the ease of the exchange traded funds and not having to choose and one particular bond over another, we get a broader diversification, which should help smooth the markets. Well,
good. All right. Bullet point 3 is what's next. So I think about what's next is not just a month from now. Things are changing every day, it seems like at this point. But what do we got as far as our highlights from the panel as to what's next?
Well, I think first we got to get the health of the country, get our arms around that. And whatever actions are going to be required are going to be difficult. And so as we're trying to do our part, you see us all sitting in different offices. I just would encourage all of our viewers to also be diligent in their social distancing, because until we get our arms around this and change the curve, flatten the curve, I guess they call it, the markets aren't going to have the positivity they need to return to normal.
Yeah.
Right. The more we know, and uncertainty is what makes things difficult. I was talking to some clients earlier today, and uncertainty breeds fear and anger, and sometimes some bad decision making. So trying to stay calm and, as Bill said, get our arms wrapped around and see where the disease is going to progress to, social distancing, everybody doing their part to help out and move us through this, hopefully a little bit faster and a little bit safer. And then when we get down to it, when we start finding those trading ranges again, less volatility, going back to a little bit more normal levels of volatility, then starting to revisit the fundamentals. And there's no getting around it. This has been a huge impact on short-term plans and long-term plans. And, we're going to have some tough conversations around, especially folks who may have been planning on retiring this year or next year, or school choices for college age kids. I mean, this is going to have an impact. So when we find that new normal, begin revisiting the fundamentals and having those conversations about plans and objectives, and going into it with eyes wide open as far as what are the adjustments that may be needed to address this. So from my perspective of what's next, let's find a new normal, and then let's have some honest, open conversations about how this impacts everybody short-term and long-term.
That's good. I think of a couple things. I think of, quite a few things, but, one, oil, they're pumping it and they've got nowhere to put it. So, to the question about what does that do with inflation, interest rates, I think that's going to probably help some places. Jet fuel, those types of things, those industries that actually use that will be able to keep costs down for a short period of time, or depending on how much they bought in the futures world, could be for quite a while. That will help profit margins for them. I think that businesses are kind of beginning to redefine what their workday looks like. The entrepreneurial mindset seems to be growing in just a couple of weeks. Jimmy John's by me, putting a table outside the front door there, figuring out different ways that they could sell sandwiches. Go to Walmart and you can't find a puzzle anywhere. Walmart 3 weeks ago, you could get 500 different types of puzzles. So, families are recreating what their daily lives look like. So I think there's going to be a shift in just a lot of stuff that goes on that, isn't just going to come down to what businesses do on a day-to-day basis. It'll be really interesting to see kind of how this evolves. But I do find that, just even people being more intentional with each other, time, all of the above, it's kind of it's a nice little reset. So I think, I don't know how that will influence business long-term, but I do think it's created a new wave of thinking, thought process, entrepreneurial mindset, that people are just taking advantage of opportunities that they didn't have before. So that could be interesting. I'm not really sure that adds any value to your question, Erik, but
yeah,
I think I'm thinking about
it. But yeah.
You know, on that, Eric, if I could for just a second, could we all just kind of have a small laugh or smile for a second and talk about, you know, entrepreneurial mindset and different ways of doing business, and just kind of throw it out there for people to caution. I mean, the big word that we're all using in more in our social lives than our business lives these days, of the use of what we're doing right now, which are Zoom meetings. And just, you know, if we could just caution everybody who might want to buy some stock in Zoom that the ticker is ZM and not ZOOM. That is something else altogether, and Matt can tell you a little bit of those details if he wants. But yeah, Zoom is now a part of everybody's lives. We all should have bought it 6 months ago. Ticker symbol ZM. So that's been something for us to kind of laugh a little bit about over the past couple of days.
Yeah, ZOOM has a trade restriction until April because people were buying the wrong stock ticker. So when the price went from $2 to $20, everybody thought they made a bunch of money.
Yeah.
The wrong Zoom.
Yeah, the wrong Zoom.
I also encourage you, if you're going to buy Ford stock, it's F, not FORD. FORD, they sell nice bedazzled jewel cases for your phones, so don't make the wrong purchase there either.
There you go. Yep, got to make sure you buy the right thing. So, all right, let's go on to, we want to move on then and kind of wrap this up where we're thinking about this in moving forward. So takeaways. Number one, we've said this already, this isn't over. We're still going to see some volatility, and obviously we don't see an end right now, unfortunately.
Yeah, it's not over. There's going to be volatility, and that's okay. I mean, we know it's coming. You know, years from now, we still have the belief that we're going to be growing as an economy, and the markets are going to be up. So stick to the game plan. That's kind of my thought. You know, yeah. Don't let this rattle you long term. Is, you know, you still have goals, you still have objectives. It's just pay attention to those, and again, rebalance where appropriate. Control your investment portfolio like you would any other day of the week.
Yeah. More stimulus to come. So we definitely see that as probably a stimulus package versus a rescue package.
Yep, and with the rescue package that we have now, we threw out some points or some ideas from the current rescue package. Approach with caution. More information to come. That remember that when the government gives, they also, you know, can take a little bit too. So as you start thinking about whether you should be making more charitable gifts or stop making a car payment or deferring a payment or something, taking money out of IRAs or 401ks, make sure that you are well aware of both sides of that. It's not just that you can do those things, but you have to do them in the right way to keep yourself out of trouble and align appropriately with the relief package. And definitely more stimulus to come. The relief package is this bridge to get us from before to after. Stimulus packages to come to kind of boost the economy and hopefully keep us from a long-term recession.
Yeah. And then our last takeaway is when the time comes, we'll continue fundamental investing, rebalancing portfolios, looking at our asset classes, where we're at, and so forth. And Bill, maybe you want to comment on that.
Yeah, so that's going to cause us to be a little bit overweighted in cash. That's okay. We're going to be a little bit underweighted in equities. That's okay, especially considering that we're going to test the downside, and nobody should be scared off by that. But when we see that trading range in a place that the four of us feel comfortable, then you know, then we'll be getting you back to the equity levels that we would like to be at. And I always tell people, if you have a penchant for risk in one of your areas, then you know we can reallocate you back to more equities. But my personal opinion is cash is king right now. Underweighting to equities is okay. We'll still make money on the upside, and we will return to normal and be able to get back to our fundamental asset allocation.
Yeah, we spent a lot of time as a team and individually, particularly, and as you can imagine, over the last few weeks, we could be on webinars and calls literally all day long, every business day. You know, we have some key partners that we do follow and keep track of that, you know, provide some good information. They obviously don't know the future, but, you know, we use them as resources as well as we're delivering it to you. Speaking of resources, I do want to make sure that you know they're on our website. So I'm going to show you here on our website as soon as I get it pulled up here that we do have, we'll pull it up here in a second. On our website, we do have a resource center, and this is right here, the resource center that you can access, as you see. And if you're on the phone call, you can go to hilltopwealthsolutions.com and click on our resource center. We've got past recordings on there, as well as updated information that we're just trying to keep you updated on. Next week on this call, so please join us and spread the word if you know someone that might be interested. We're going to get into more details on the new bill that was just passed and the rescue plan that was just signed. We'll get into more details. Obviously, it's going to break down based on your situation, but we'll give you some good highlights. And then, individually, if you're a client, we're going to start going through and determining what makes sense, what doesn't make sense, those kinds of things as well. And with that, I'm going to wrap up. So Bill, Beth, Matt, thank you so much for joining us today. I appreciate it. Thanks for all of that. Thank you for all of you joining us. If you are a client, thank you for being a client and trusting us. We're working really hard to give you good guidance along the way. We don't want mistakes made because of emotion, and we will get through this. It'll be some time, but we will get through it. Until then, I hope everyone stays healthy and safe, and we will talk to you next week. Thank you so much.
Bye.